Welcome back, dear students and scholars. In video 1, we focused on what belongs in inventory and when control transfers. Now we move to the next question under ASC 330. Once the goods belong to the entity, what cost should be attached to them? Inventory cost is not just the supplier invoice. It includes the cost required to bring goods to their present condition and location, ready for sale or use. In this lesson, we will separate what enters inventory, what stays out, how overhead is allocated, and when a capitalized cost finally becomes an expense. Cost capitalization matters because it changes timing. If a cost is capitalized into inventory, it stays on the balance sheet as an asset until the related goods are sold. When those goods are sold, the cost moves into cost of goods sold and affects gross margin. So capitalization affects the balance sheet today and the income statement later. It also affects audit evidence, policies, consistency, and sometimes even SEC comments. Inventory is one of those accounts where timing is everything. Put the cost in the wrong period, and the financial statements start telling the right story in the wrong chapter. Here is our learning path for video 2. We start with the core AC 330 cost rule, which is the condition and location idea. Then we build merchandise inventory cost, including invoice price, freight in, transit insurance, and handling. After that, we move to manufacturing layers, raw materials, work in process, and finished goods. Then we discuss overhead allocation, especially the difference between variable overhead and fixed overhead. Finally, we separate abnormal and period costs from product costs and apply everything in a manufacturing mini case. Cost flow methods such as FIFO, average, LIFO, and specific identification come in the next video. Today we build the cost pool first. The core cost rule is that inventory should include costs needed to make goods ready for their intended use or sale. A cost may be direct, such as materials traceable to a unit, or indirect, such as production overhead allocated across units. But the cost must relate to acquiring or producing the goods, and it must be necessary to bring the goods to their present condition and location. This is the foundation before any valuation test is applied later in the series. Build the cost correctly first, then later ask whether that cost is still recoverable. For merchandise inventory, the cost normally includes more than the supplier's invoice price. The invoice price is the starting point, but freight in, transit insurance, supplier handling charges, and other necessary costs to make goods saleable may also be capitalized. The cost build generally ends when goods are ready for sale in their current location. After that point, costs such as selling activities or freight out do not become inventory cost. A common exam mistake is treating freight in like an operating expense. Freight in brings goods to the buyer, so it is usually part of inventory. Freight out sends goods to the customer, so it is a selling expense. Purchase discounts can be handled using either the gross method or the net method, but the chosen method must be applied consistently. Under the gross method, the purchase is recorded at the full invoice amount, and any discount actually taken reduces the purchase cost. If the discount is not taken, the full invoice amount remains. Under the net method, inventory is recorded net of the expected discount. If the entity pays late and loses the discount, that lost discount is recorded separately as a financing type expense, not as additional inventory cost. Conceptually, the net method is cleaner, but the gross method is very common in practice because it is simpler. Manufacturers have a more layered inventory process than merchandisers. Raw materials are purchased, inputs not yet placed into production. Work in process includes goods that are partly through production and carries direct materials, direct labor, and allocated overhead. Finished goods are completed units waiting for sale. Only when the finished unit is sold does the cost move from inventory to cost of goods sold. For a manufacturer, the question is not only what did we pay the supplier, The better question is, what did it cost to convert raw inputs into finished goods? Under USG AAP, manufacturing inventory uses full absorption costing for external financial reporting. This means product cost includes direct materials, direct labor, variable production overhead, and allocated fixed production overhead. Variable costing, which excludes fixed overhead from inventory, may be useful for internal management analysis, but it is not acceptable for external reporting under ASC 330. Fixed production costs are part of the cost of making goods, so they attach to units. The cost accumulates in work in process, transfers to finished goods, and then becomes expense only when the unit is sold. Now look at the raw materials example. The entity purchases components for $80,000. Freight in is $3,200. Transit insurance is $900. And supplier handling charges are $600. All four amounts are necessary to bring the components to the entity's location. So the total raw materials inventory cost is $84,700. The entry is debit raw materials inventory for $84,700 and credit accounts payable for $84,700. If we recorded only the invoice price, inventory would be understated by $4,700. Direct labor is a conversion cost. It includes wages and related payroll costs for workers who directly assemble, process, or manufacture the units. As production happens, direct labor is debited to work in process along with direct materials and overhead. When goods are completed, that cost transfers into finished goods. It does not hit the income statement just because payroll was paid. The cost follows the unit. That sentence is very important. The cost follows the unit, not the payroll date. In manufacturing accounting, payroll can travel through inventory before it ever reaches the income statement. Indirect overhead includes production costs that support manufacturing but cannot be traced neatly to individual units. Examples include factory depreciation, factory rent and utilities, indirect labor and supplies, production supervision, quality control, and normal scrap or spoilage. The key word is production related. General and administrative costs, such as executive salaries or corporate IT, should not be pushed into the factory overhead pool unless there is a clear production link. Overhead is useful when it captures real production support. It becomes dangerous when the pool turns into a storage room for costs that nobody wants to expense. Variable and fixed overhead behave differently, so they are allocated differently. Variable overhead changes with production volume, so it is allocated based on actual production facility usage. Examples include indirect materials, variable utilities, and variable maintenance. Fixed overhead does not change directly with volume, so it is allocated based on normal expected production capacity, not actual production. Examples include factory rent, plant depreciation, and supervisor salaries. This distinction is heavily tested because using actual low production as the denominator would artificially increase unit cost and push idle capacity into inventory, which ASC 330 does not allow. The normal capacity rule is central to fixed overhead allocation. The formula is budgeted fixed production overhead divided by normal capacity. Normal capacity is not maximum possible output, and it is not simply the current period's actual output. It reflects expected production under normal conditions, considering normal shifts, scheduled maintenance downtime, realistic production ranges, and entity or industry experience. Management must document the basis and apply it consistently. Normal capacity is not a magic number from the accounting sky. It is a judgment, and like every good judgment, it needs evidence. When actual production is above normal, the overhead rate is reduced so that total allocated fixed overhead does not exceed actual fixed overhead incurred. In other words, high production cannot create extra inventory cost beyond actual overhead. When actual production is below normal, the company does not increase the rate to load more fixed overhead into each unit. Instead, unallocated fixed overhead is expensed in the current period. Low production creates idle capacity cost, and that cost is a period cost. The core rule is simple: inventory carries normal production cost, not the cost of unused capacity. Abnormal costs do not enter inventory, they are expensed in the period incurred. This includes idle facility costs from unexpected shutdowns, excessive waste, abnormal spoilage, unusual freight or handling caused by errors or emergencies, and major avoidable rework. Normal scrap or normal spoilage may be part of production overhead, but abnormal loss is different. It reflects mistakes, disruptions, or unusual events. Capitalizing those costs would overstate inventory and delay recognition of a loss. Inventory should carry the cost of normal production, not the cost of surprises that management would rather forget. Some costs stay out of inventory because they do not have a clear production link. Selling costs are expensed as incurred because they happen after goods are ready for sale. Most general and administrative costs are also period costs because they do not directly create inventory. Production related administration may be included if clearly linked, such as a plant manager's salary, but a CFO salary is not capitalized just because the company manufactures goods. Exit or disposal costs follow their own relevant guidance. The practical test is not whether the cost is near the factory. The test is whether it is necessary to bring goods to condition and location. Interest capitalization has a defined boundary. Routine inventory manufactured in large quantities through a repetitive production process generally does not qualify for interest capitalization. ASC 330 excludes ordinary repetitive inventory production from interest capitalization rules. ASC 835 may apply only to qualifying assets that take a substantial period of time to get ready for intended use or sale, such as custom built machinery made for a specific long term customer order. So, do not force borrowing costs into normal mass produced inventory. Interest capitalization is the exception here, not the default setting. Now, let us apply the rules to Apex meters in 2027. Direct materials of $240,000 are capitalized because they are product costs. Direct labor of $90,000 is capitalized because it is a conversion cost. Allocated normal overhead of $70,000 is also capitalized under full absorption costing. Together, those three amounts equal $400,000 entering work in process. Abnormal spoilage of $12,000 is expensed, and the selling campaign of $18,000 is expensed, so total period expense is $30,000. The entry is debit work in process $400,000, debit loss or period expense $30,000, and credit cash or payables $430,000. The debits and credits balance and the accounting conclusion follows the production link. Let us finish with 5 rules before we move to cost flow methods. First, capitalize necessary acquisition and production costs using the condition and location test. Second, merchandise inventory includes freight in and transit insurance when they are needed to bring goods to the selling location. Third, manufacturing inventory uses full absorption, including direct materials, direct labor, variable overhead, and allocated fixed overhead. Fourth, fixed overhead is allocated using normal capacity, and idle capacity cost from low production is expensed. Fifth, abnormal costs and selling costs are period charges. In the next video, we take the cost pool built here and apply cost flow methods such as specific identification, weighted average, FIFO, and LIFO. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who want a clear US GAAP explanation. I will see you in the next ASC 330 lesson.